Today, we are going on a hunt, not for buried treasure, but for something that can feel just as exciting for an investor: really, really high dividend yields. We're going to dive into what these yields actually mean, using some pretty fascinating examples from Sri Lanka's Colombo Stock Exchange.
So let's just jump right in with a big question. What if you could find a stock that pays you over 20% of your investment back every single year just in dividends? I mean, that sounds almost too good to be true, right? And that's exactly what we're here to figure out.
Okay, first things first, let's make sure we're all on the same page. What is dividend yield? Super simple. It's just how much a company pays you in cash dividends each year compared to its stock price. For anyone who loves income investing, this number is a big deal. It's your cash return for just owning a piece of the company. So here's how we're going to break this down. We'll start with the hunt for high yields, then talk about the headline number versus the hidden risks. That's super important. We'll look at some real-world case studies with some crazy high yields, and then some that are just strong. And we'll wrap it all up with a practical checklist for you.
This right here is the heart of the matter. You see, an unusually high dividend yield isn't just a reward, it's a signal. It's the market basically screaming at you to look a little closer and start asking some tough questions.
And this really lays out the two sides of that coin perfectly. On one side, you've got the amazing promise, right? High returns, consistent income. It looks like a huge opportunity. But on the other side are the questions you have to ask. Can the company actually afford to keep paying this? What's the hidden catch? And the biggest one of all, why is this yield so high in the first place?
All right, let's get to the really juicy stuff. We're going to start with the stocks that have those eye-popping, make you do a double take kind of yields. Okay, just look at this. First Capital Treasuries, with a yield somewhere between 23 and 30%. That is a massive number. To put it in perspective, if you put in $10,000, a yield like that suggests you could get back up to $3,000 in just 1 year. But hold on a second. Before you get too excited, you've got to ask these questions. Is this a one-time thing, like a special dividend that's never going to happen again? Are the company's actual earnings, their real profits, strong enough to support this kind of payout year after year? A yield this high could actually be a huge red flag. Let's look at another one. Its parent company, First Capital Holdings, coming in around 19 to 20%. Again, an unbelievably high number that just begs for a closer look.
So here we go again. We have to dig deeper. What does this company actually do? Where are the profits coming from to fund this dividend? Has this been a consistent thing, or is it a total anomaly? A yield this high often signals a risk that's just as big, and it's your job as an investor to figure out what that is.
Okay, so let's move beyond those truly mind-boggling numbers. Now we're going to look at companies with yields that are still incredibly strong, but maybe a little more believable. The core idea, though, it's exactly the same. You have to investigate.
First up, we have Vallibel Power, a utility company with a yield around 13%. Now, utilities are usually seen as these kind of boring, stable, defensive stocks. So when you see a double-digit yield like this, it definitely makes you lean in and pay attention.
But even in a sector that seems safe, you got to do your homework. How much debt is this company carrying? Power companies need a ton of money, and a lot of debt can chew up the profits that are supposed to go to you. Are there any government regulations that could just change on a whim and hammer their business? And, as always, is this a one-time fluke or is it repeatable?
Next up, Ceylon Tobacco Company with a really solid yield of around 9 to 10%. This company absolutely dominates its market and has a long history of paying out dividends. On the surface, it looks like a rock. But this company is the perfect example of why you have to look at industry-specific risks. The tobacco industry is under constant pressure from new taxes, new regulations, you name it. Is their market actually shrinking over the long term? Because if it is, that's a direct threat to future profits. You have to weigh their current dominance against the major headwinds facing their entire sector.
Okay, shifting gears to the plantation sector. We've got Walla Walla plantations, yielding about 8.5 to 9%. And this industry, well, it has its own completely unique set of challenges. For a company like this, its profits can be completely at the mercy of global commodity prices, which can be incredibly volatile. I mean, one year prices spike and they can pay a huge dividend. The next year, prices crash and that dividend could completely disappear. And, of course, you can't ignore risks like bad weather or crop diseases. It's all about consistency here. And for our last case study, we've got Alumex PLC from the materials sector, coming in with a nice solid 8% yield. Now, for a materials company, you have to think about the economy as a whole. Is this a cyclical business, meaning does it do great when construction is booming, but really suffer when there's a recession? Because that directly hits the dividend. Do they export a lot? If so, they could be vulnerable to currency swings. Just taking a quick look at their dividend history will tell you a whole lot about how they handle these economic cycles.
So, we've gone through all these different examples and we've asked a whole bunch of questions. So now, let's pull it all together into a really simple, actionable checklist that you can actually use.
This is basically your 4-step mental model. Step 1, investigate the source. Is this real, repeatable profit or a one-off gimmick? Step 2, check the history. The past doesn't predict the future, but it gives you some serious clues. 3, understand the risks. Every single industry has them. And finally, number 4, assess sustainability. Can this business actually keep this up for years to come? And I think this quote just sums it up perfectly. A high dividend yield is not the finish line, it's the starting gun. It's a signal that your real work, your research, is just getting started. So, I'll just leave you with this final thought. The next time you see a stock with a crazy high dividend yield, is it a red flag telling you to run for the hills? Or is it a green light for a fantastic opportunity? The real lesson here is that it's neither. It's an invitation to dig deeper. And the real answer, that's always going to be found in your own research.